Hey everyone, this is Ryan Mallory with SharePlanner.com. Today is November, what the heck is it? November 5th, 2015. Doing another live Google Hangout with you guys. So let's go ahead and let's talk about these markets here. First off with the S&P 500. I mean, the big question is we got a little less than 2 months left in the trading year for 2015. Can this market really keep ramping up like this into the close? We are back in positive territory, not by much, a little less than 2%, but the S&P 500 is in positive territory, and that's a big deal. I was reading today that still like 28%, only 28% of hedge fund managers are actually outperforming the market, which just shows you, like, I think the average is like 50 or 46% on a year-to-year basis. That's the baseline of people who outperform the market. And they're at 28. So there's a huge cluster of traders trying to keep up with this market here. So I guess the short answer is, yeah, it really could continue to rally through the year. And we're in the most bullish quarter of the year. We're in obviously the most bullish months of the year. This market could easily continue to skyrocket, into the end of the year on a pretty ferocious in a ferocious way. So I wouldn't try to start loading up on short positions heavily right here. If you want to hedge your portfolio, that's one thing, but to take a day like we've had today where we did sell off initially and we bounced back some to form a bit of a doji candle here on the S&P 500 as we near the final bell, that's not something that screams at you, hey, you need to get short on this market. Not at all. Now, if you go back to the earlier part of this year where we were trading in this huge range right in here, okay, that screams, okay, when we break this range, get short. And that's the only way you could have played it. But a 2-day pullback here, and if you look at it, each of the past 4 weeks, we have had a 2-week or a 2-day pullback, and each time it's taken it right back to the 5-day moving average, and it has blasted higher. So we saw it. Actually, it's the last 5 weeks. Good grief, I didn't even realize it was the last 5 weeks. But yeah, last 5 weeks. It's not always been to the 5-day moving average. The last 2 times it's been to the 5-day moving average, and this time here it's trying to stick to that 5-day moving average. But it's either been the 10 or the 5, and in both times, I mean, you can see, boom, right there, another one right there, another one there, and another one there. So if you're playing the odds say that the S&P 500 has a good chance of rallying tomorrow off of the jobs report. I can't say that for sure. I don't know. Okay, the jobs report could be interpreted negatively and the market sell off. But you've got a good chunk of evidence there that the market has consistently rallied off of these minor 2-day pullbacks. So I have been adding some long positions over the last 2 days. I added the Russell. So let's go ahead and look at the Russell here. I really like this particular chart. The reason being is that I need to get rid of this thing here first. May or may not let me here. All right, so you look at the Russell here. You've got an inverse head and shoulders pattern. Yeah, the left shoulder is a little bit sloppy, but you can understand like the spirit or the nature of the price pattern here. You got the left shoulder, you got the head, and then you got, again, the right shoulder. And then you got the confirmation here happening right around, that 1180 level. Now we're trading at 1190. It looks pretty solid today. This thing is far removed from its all-time highs. I mean, this thing could rally up to 20 or 1293, 1295 before, over another 100 points before it actually reaches its all-time highs. But this is a index that really needs to play catch up with the Dow and with the S&P 500, and it has had some problems with that over the past couple of years. So the price pattern is awesome. That inverse head and shoulders pattern allows you to keep the risk tight and to play it with a lot of upside, and that's what I'm going to try and do here. And I'm using, obviously, IWM. This is something that I notified yesterday of traders in the splash zone that I was getting long on. I got long at 118.08. So not a lot of gains yet. It's just barely moving. It's basically been recovering its losses throughout the day. And then, I mean, if it crosses below this 115 level, you know there's definitely something not working right in the trade. And so that's one of the biggest aspects of a trade, is to identify before you get into the trade of where can this trade go wrong at. And if you don't identify that, then you shouldn't be trading it. And sometimes I see a really good chart pattern, something that looks really attractive, but I cannot find the area of where do I get out if this stock doesn't go right for me. And if I can't find that out, I got to step aside and just move on to the next chart, because there's always another chart out there. Any given day, I can find a trade setup. Sometimes it's harder than others. Like a market like this, it's hard to find a short setup that's really appealing. I thought I had one earlier in the week with Best Buy. Obviously, that didn't work out. But and then you go back into like September. For most of September, you couldn't hardly find a good long setup at all. So, but they are out there. They're always out there. You just got to keep digging for them. And if you can't find on a chart where the trade goes bad at, and it's not always really transparent as to where that level is. But if you can't identify it, and it's not a bad thing if you can't, it doesn't impugn your ability to be successful at trading in the stock market. In fact, it's the exact opposite. It's a sign of your maturity in the stock market, of being able to say, hey, I can admit when I don't know where a stock trade can go bad at. And when you can't identify that, don't trade it. So with IWM, below 115, it doesn't go well for me below 115. I recognize that, and I can trade with a tight risk and a much nicer reward, because the downside is okay, I might lose 2.5% on this trade. To the upside, okay, if it rallies back up to the all-time highs, I'm making like 4-1 on that. I don't know exactly if it's going to go all the way up to all-time highs, but it very well could, especially if it tries to start playing catch-up in the coming days with the S&P 500. But if you make 3-4% off of it, you're easily outpacing the risk that you put on the trade. So that's the IWM. The other chart here, and I don't have a position in it, but let's go ahead and look at the Qs here. Obviously, totally different price pattern than what we have seen, like with the S&P 500 and the Russell. The S&P 500 is close to its highs. It's about 35, I think, points off of its all-time highs. You look at the NASDAQ, though, the Qs, because the Qs aren't always going to match, just like the SPY isn't going to always match the S&P 500 perfectly. The Qs won't match the NASDAQ composite index perfectly either. But you can see, though, even with like SPY's not at its all-time highs yet, but you look at Qs, Qs is kind of making new all-time highs. So the NASDAQ, I mean, you got Facebook today rallying, big. That's going to help the market out some, or particularly the NASDAQ. And for earnings purposes, from Amazon to Microsoft to Google, and it's kind of Apple, you've had a really, really good earnings season for tech. So that's definitely helping the NASDAQ out a lot. So I do have some long exposure in the tech side, namely with Apple. Apple is concerning me though some today. I'm really concerned. It's not as down as bad as it looks. It's only down about 0.5%, which isn't catastrophic or anything. But this chart hasn't adjusted for its dividend yet, so I have to play that into my mind a little bit to make sure that whatever decision that I make, that I make sure that I account for the dividend that was taken out of the stock today at 52 cents. It's down $1.28. So really, there's about an 80-cent sell-off in the stock today, or about a 0.6% loss. Not too bad, but I would like to, even so, I'd still like to see it close above the 5-day moving average. But the stock has been on a really good tear of late. I really want to hold it beyond to today. We got to see how the market closes though first. And then you got AAL. This thing has been sort of like a thorn in my side the last few days. We keep gapping up in this thing, and then we just sell off. So, a couple of days ago, we had a nice 2% gap up, and then it just spent the rest of the day giving up most of those gains. But the last 2 days, it's bounced off of this converging 20-day and 200-day moving averages. So I want to see some strength off of that here. The candle looks really good today, looks sharp. It spent most of its day rallying back despite of the back and forth of the market. So I don't see this as a trade that's gone rogue on us yet. It's still worth holding. I think that you look at the grand scheme of things, this chart, going back the past, 4 or 5 months, it's still a very bullish looking chart. A few other positions in the portfolio. You got CRM. Really not done much for us yet either. And it's not like I've been holding these stocks for a long time. I've been holding CRM since the 2nd of November. It just hasn't really moved for us yet. But it's holding the support. That's what really matters. When I talk about knowing where the trade has gone wrong for me and knowing when to get out, CRM has not done that yet. So even though, okay, it's been down to the last 3 days, it really hasn't done anything for us since getting into the stock. It hasn't broken the trade setup yet either. So that's important to realize, to keep things in perspective. Yeah, nobody likes to lose 3 days in a row on a stock, but in the grand scheme of things, that's easy to recover from in a moment's notice. So I like the setup still. I like how it's holding the support levels there, and I'm going to continue to hold it. You look at some of these banks. The banks look pretty good right now. I like JPM. You take JPM here. It's moving a little bit higher this morning. You take GS. It's trying to break out of that pattern there. I haven't even looked at Citigroup yet, but I'm guessing it's the same thing. Yeah, Citigroup, it's got some nice moving averages underneath it. So it's a lot of it's a similar pattern. You look at Morgan Stanley. It's been a little bit weird. It's been stuck in this triangle, but even today it's moving up about 2% higher. So I like a lot of these banking stocks. I went ahead and decided to go with XLF. It represents all of them, obviously, because it's the financial ETF, but I can also keep this stop loss pretty tight on this one. And I frankly, I really like this coiling action here. You can take this trend line, and it is a beauty of a trend line. And I outlined this for members of the Splash Zone earlier this morning. You look at that, it's holding that trend line really well. And then obviously you got that coiling right at those recent highs. If it get above and stay above 2450, it's at 2451 right now. I'm pretty optimistic about its chances for tomorrow. Some stocks that I'm not in, but definitely worth watching. PH. I got a lot of lines on this one too because I've been marking it up quite a bit lately. But you got this downward. Or declining resistance level, downtrend, I guess. You got a triangle here. It needs to get out of the triangle or the neckline of this inverse head and shoulders pattern. I'll draw this line out a little bit further. But yeah, left shoulder, head, right shoulder, close to breaking out. It actually did earlier in the week, but it gave up the gains yesterday. But it's close to breaking back out. I really like that stock. I think it looks pretty good. And a lot of the industrial stocks too lately have seemed pretty good when they come up in my scans. ETFC, similar to what we saw in XLF, that nice little coil at the highs. Not the same kind of uptrend, but it's a little bit more jagged. But the coiling from the last 6-7 days looks pretty impressive there. You can get long over 29, and I think it would be a pretty good trade. JNS. Another coiling play, another inverse head and shoulders. There's a lot of inverse head and shoulder patterns out there right now. And it's just, because of how the market reacted during the, the August, September sell-offs there. The S&P put in a double bottom, but it was very easy considering this huge sell-off, the second sell-off, and then, a little bit of a dip there that you could create a head and shoulders on a lot of charts right now. So, and then, of course, on the Russell, I've already pointed this out, but, you had the inverse on the Russell too. So that's affecting a lot of the charts that we're seeing too. So JNS, it's got that same kind of pattern. It's got the nice coiling above the neckline. It's also in the financial services group, but it's very solid. Oil's been it had a couple of good days earlier this week. Last couple of days, it's not been so hot. But this particular one, it's rallied nicely. For me, I know where the trade goes bad at on CRZO. For me, it would be if the stock broke below the lows from 1027, which is at like 34.50. It's trading at almost $39 now. So, I don't want to take a $4.50 stop loss on this. So, for me, the problem isn't identifying where the trade goes bad at. The fact is I have identified where the trade goes bad at, and despite it being a pretty nice price pattern that has broken out of this, double bottom pattern, rallied nicely, and then pulled back pretty much in an orderly fashion to this breakout level. I like the price pattern. It's good, but I can't trade it because I'm not willing to take that kind of risk on a trade, because in order to really justify it, I need about a 20% move out of the stock, which means I pretty much need to get up to like $47 a share. And, I don't go into trades. It's nice when it happens, but I don't go into trades with those kinds of expectations. So keep the risk tight. That's what I do. Final one, OSK. Hasn't quite broken out, but I mean, there's a lot to like about this stock. You know what? I'm going to throw another stock in there too after this one. But OSK, another, I don't know, you could call it a triple bottom, but I'm still going to just call it a double bottom. One bottom here, don't know what the heck that is, but you got your second bottom there. And then, $43 or so. This sucker is going to be breaking out. I like the Oshkosh trade. It looks pretty good. You can identify where this trade goes bad for you. I would say if it breaks below this 4-day coil, that's probably your sign to get the heck out of it. So 40.92 is a stop loss, 43-ish for an entry. And you got a good risk reward trade set up there. Final one, and I do mean final one this time, Hasbro. Downtrend off of the July highs, definitely broken. But you got a clear level of resistance going back here to mid-August, and that's what I'm really following at this point. I don't want to get long just because it's broken that downward resistance thing, but it is pretty nice actually how it's finding support underneath. But yeah, this resistance level here, definitely one to pay attention to. If it can get above that 79.35 level, man, I think this is really a nice trade. You can put it probably a stop loss below this little price range here. And you got a fabulous risk reward setup. So that's one I'm definitely going to be watching tomorrow as we close out the week. If you have any questions, feel free to email me about anything about Share Planner or, just about anything. You can email me. My email is ryan@shareplanner.com. If you're interested in trading with me and, and being in my chat room each day, receiving my swing trade alerts that I take each day, you can join the Share Planner SaaS Splash Zone for a free 7-day trial. That means you don't have to put any money down. You'll get everything that a regular member gets for those 7 days. And you can sign up by going to shareplanner.com/splash zone. Once again, that's shareplanner.com/splash zone. So, I hope to see you guys in here, and you guys have a great day and a great rest of the week trading. Take care.